Hello and welcome to a fresh new edition of Value Investing Decoded. With me now is Navneet Munot, who has almost about 2 decades of experience into fund management as well as investing. He's always on the lookout to find new growth opportunities, to find value in the market, and in turn creating wealth for various number of investors that he has. Navneet, thank you so much for taking out time for us. Just for our viewers, who are trying to learn research, who are trying to identifying opportunities, maybe they are very, very initial, maybe they have already tried. Can you just explain them why value investing is so interesting? Buy low, sell high, look at high ROEs. Can you just explain that?
So actually the financial theory tells you that markets are efficient and it's very difficult for any individual to beat the market on a sustainable basis. Having said that, there is a history that lots of investors have been able to do that. They've been able to identify securities which could outperform the market. You need to have an investment philosophy which works over a longer period of time, need to have a right process in place and needs to have a discipline in place where you use that investment philosophy and then thereby you outperform the market. Now value investing, again, it's a very generic term since the value is like beauty. It's in the eye of the beholder. Different people have a different connotation, different interpretation of the value investing. In our case, we would say that wherever you're looking at in business, the intrinsic value of that business, if you can buy it at a price which is lower than that, then of course that's kind of value investing. If you can buy securities which can do either, from an absolute return perspective, delivers absolute returns, but more importantly, equally importantly for us, relative return, beating the market and beating the right peer set, that's critical. So there are various ways to identify those securities. We can discuss more in detail, but fundamental thing is that if you have the ability and the resources where you can identify securities that can do better than the market, that's I think the investing. And there is no holy grail of investing. As you said, value investing, there are people who believe in mean reversion to the mean. So if let's say a security is trading below its historical valuation, then probably it will come back to the mean. There are people who are contrarian investors, anything that the market is doing, and then you have a different belief. There are people who do different kinds of arbitrage or special situations. So there is no holy grail of investing. You need to identify what is your strength and where you can outperform. That will differ from individual to individual or institution to institution.
Right. You have a lot of retail investors within your portfolio. What is the first part towards getting right investment? Will the first part of value investing be also about getting the right asset allocation between debt as well as equity?
So if you are asking about an individual investor, I think that's the first aspect. You need to know why you are investing. What is the goal of that investment? Is it like to buy a house 10 years later? Is it to accumulate certain savings for your retirement? Is it that you need to save for your children's education or marriage at a later date? What is the time horizon? How much risk you are willing to take? Risk in this context is the volatility of return. How much downside you can take? So if let's say you are looking at a regular income, then a lot of money should not be in equities, because equities may have a huge drawdown. You can have a year where market is down 20, 30, 40%. So depending on your return expectations, your time horizon, your liquidity preference, and then the other tax and the other personal preferences, you need to design an asset allocation, and within that asset allocation buy the right kind of securities. Now of course, through a professional fund managers like us, one can put in the right kind of funds which deliver him his return expectations within the overall risk appetite that an individual investor has got. So asset allocation and then staying within a disciplined manner to that asset allocation is very important.
Before we go into the various stocks or the individual analysis of various companies, can you just tell us that as far as SBI mutual fund is concerned, what is the philosophy that you follow? You look at quantitatives very closely. Also, you look at various other aspects like what are the risks related to environment. Can you just explain our viewers about that?
So our idea is to generate superior risk-adjusted return. When I say superior, are basically beating the benchmark, beating the right peer set. When I say risk-adjusted, adjusted for the risk that you take. I mean, if you have a portfolio where there's extreme amount of risk in fixed income, it could be liquidity, interest rate, credit risk. In equities, it could be a different kind of risk. So risk-adjusted returns on a consistent basis with a long-term orientation through a fundamental research approach. So you basically look at individual companies. So we basically run two different kinds of philosophy. One, what we call a relative return philosophy, where the idea is to beat the market over a 2 to 3 year time frame, which is mostly applicable to large caps, where you're looking at factors like the sales growth margins, I mean the momentum in the revenues, margins, and the profits, because you believe that a company that's doing well will continue to do well. You look at the market expectations, what the market is pricing in versus what are your expectations. You look at the valuations compared to their own history, compared to the peer set within that industry, and then you identify a stock which you think that can outperform the market over a 2 to 3 year period. We have another philosophy which is an absolute return philosophy. But remember, I mean, this is in a long only context. We are a long only investor. We don't short any security. So if market goes down substantially, stocks will go down. But when you're buying a stock, your idea is that it can generate absolute returns over a longer period. There, the minimum time horizon is 3 years. There you are looking at competitive advantage. There you are looking at return on equity. There you are looking at growth. Of course, you have the qualitative aspect of the management and valuation, last but not the least, and that's equally important. And then you identify a security which you believe, based on these parameters, can deliver absolute returns from a 3 year plus perspective. That is more applicable to mid and small caps.
Right. Can you just start as a fund manager, you have a responsibility to identify good stocks. Can you just start by the process? What's the first thing? If somebody tells you that you want to buy X stock, how do you start approaching it? Is the first thing numbers? Is the first thing looking at the dynamics of the market? How do you approach it?
So it sounds like a cliche that one should buy good businesses run by quality management, good management available at a reasonable valuation.
But it doesn't happen.
Easier said than done. So now, what is a good business, right? I mean, a business which generates return on equity or return on capital employed more than the cost of the capital, right? Then only it's a good business. Now, how that happens? The company needs to have a competitive advantage, right? Otherwise, in a competitive market, there would be other players, and the overall returns will gravitate towards the cost of capital. So, company needs to have a competitive advantage in place. You need to have, as I mentioned about the return on equity, at the end of the day, as an equity investor, what you're looking at is the return on the equity, return on your capital. We can discuss more in detail. We need to have growth in that business, right? So, I mean, if you're paying a valuation of a certain time over a longer period, you're looking at this business will keep growing at a certain pace. And you look at the management, and as I mentioned, you look at the valuation. Now, most important to me, I think, is that competitive advantage, and where people, I think, spend less amount of time. The most important is whether the company has got a competitive advantage which is sustainable, and whether that, I mean, in Warren Buffett's language, whether that moat is expanding or whether the moat is shrinking. And how do you create the sustainable competitive advantage? Various things. A company may have a patent, a company may have certain brands that's why the customers pay them more. There could be a switching cost where customers find it difficult to move to another product. There could be a regulatory edge to that company. It could be a cost leader, variety of things that gives a competitive advantage to a company. You also have to see whether that business inherently, I think I'll talk about what according to me is a very important thing when you look at the industry itself, and then you apply the Michael Porter's 5 forces. Whether the buyers are more powerful, whether suppliers, the buying power, the suppliers' power. You look at the threat of the new entrants, whether the new entrants will come and the return of equity will gravitate towards the cost of the capital, or the new products that can be substituted, and the competitive intensity in a business. There could be great businesses, some of the business which are growing very fast, but the competitive intensity is such that one particular player cannot make money. So how do you create that competitive advantage? for yourself. Return on equity, I mean, that's the most important thing. And when you watch TV, you don't hear those words too many times, return on equity or cash flows. I think people pay far too much attention on what's the PE or what's the earnings on a quarter-to-quarter basis.
Just putting this competitive advantage, I know you cannot talk about stocks, but I was looking at your portfolio, which is publicly available. So something like Eicher Motors, Page Industries is what you have. I'm not talking to you to give a stock call, but what went through your mind when you were researching about them, when you were trying to make investment, increase the allocation? What sort of competitive advantages did you look at?
Different companies will have that different. So in a market like, let's say in a growing economy like India, you need to look at the size of the opportunity, an industry which is growing. But when an industry is growing, obviously there could be several players who could be your competition. Then how do you run your business differently than most of the other players? How do you create that brand? How do you create that distribution franchise? How do you create that brand franchise? How do you create a product at a price where the customers are coming to you? And in some of these companies, I think they had that value proposition for their customers where they found it difficult to switch to another products, right? So that's the competitive advantage that a company has, which is difficult to break for anybody else. Look at the history over the last 100 years globally. I think the companies that have generated that return on equity on a sustainable basis, or on that longevity that comes from the ability of the company to differentiate themselves from most of the other players, which could be a variety of things. As I said, that it could be a technology, it could be your agility in the market, it could be the value proposition you have, it could be somebody could be a cost leader where it's very difficult to beat him, the cost at which he can produce. Different things would be for different people. Market is open to everyone.
Right. So just about Page Industries, there were some issues as far as whether the growth will continue, whether they'll have the competitive advantage. We're getting new competition very, very fast. How do you get convinced?
There's so many players for long period. This is not in like industry which is like very, very recent, right? But how somebody could grow much faster than the other people, earning margins which are higher than the other people. You're growing market share, at the same time you're growing your margins, and then you are surprising the market every quarter, every year. So obviously there are some ingredients in the way they were running the business that they could do it over a period of time where most of the other players could not do it. It's just like, let's say, a very small thing. For example, I mean, having some of the raw material which is required, producing yourself, because you know that the quality of that particular material which goes in the final product is very, very critical for customer to stick to that product. The brand, the way you position it, that when the customer goes to the shop, he asks for their particular brand because you are providing him a value, you are providing him a product which he is not finding somewhere else at that price point.
So, for a retail...
And you're not trying to every time just compete on the price alone, because customer is willing to pay you a certain premium because he's seeing that value, and creating that perception about that. One is delivering that product and creating that perception about that product, I think is also important.
So, that was about looking at the company from an overall view. But, for our retail viewers, sometimes it may be difficult to, find the exact market share and things like that. Can they very simply just look at how their lives, their friends' lives are changing? Are they shifting towards new things? Are they changing? At least for the basic start, would that be a good sort of
So large part of the investing is, as Buffett calls it, a common sense investing. Having a very high IQ actually can go against you. I think a lot of it is like commonsensical in terms of looking at certain companies, looking at certain management, looking at certain businesses. You get this sense that yes, they are differentiated, they are doing some right things. But then you need to put tick lots of boxes. It's not only about something that probably you come across that this industry is doing well. I keep giving this example of the telecom where, let's say 10 years back, had I told you that mobile subscribers in India will go from 10 crores to 100 crores, the data business will grow so much. But look at the companies, I think whether they could convert that market opportunity into profits that could be shared with the minority shareholders, not necessarily, because the competitive intensity, the regulatory developments, the benefit went to the consumer, benefit benefit may have gone to the equipment suppliers, benefit may have gone to the government, but not to the company. So the understanding that industry dynamics is like quite important. And then also look at the valuation we can discuss.
Right. So the first mantra is they should have a competitive edge, they should have a decent brand or at least a brand building process, and the market should be big and the product should be
And
good.
very important is that focus on the return on equity. So several companies in India particularly, and I think that's true of most of the other emerging markets, where the management's focus on capital allocation, the understanding the importance of capital allocation. You have a very good business, but in the looking at the overall drivers of the business and the growth of the business, at the end of the day, what's most important is the return on equity. So there could be a growth, but if that growth is coming at the cost of putting more capital, if the working capital needs are increasing, which is true of, let's say, lots of, just for example, let's say construction companies or some other companies where you're growing very fast, but then the working capital is increasing or it requires a lot of investment, then as an equity investor, you are not benefiting, right? Because the return on equity is not improving. So that's very, very critical. At the end of the day, what's important is, the earnings that you have, the cash flows that you generate, and the return on equity that you get as an equity investor.
Right.
So just the size of opportunity and some business is growing, that alone is not important.
So, we should look at the ROE. How would you look at, the importance that management wants to share with its investors? We always say that, management is credible, management is of a great quality. How do you identify that?
So those are the softer aspects, right? So everybody is looking to find the next guy who could probably be, without taking names, the next most successful, let's say a banker like Aditya Puri, what he has done with HDFC Bank. And then again, if you look at the theory, so let's say the Buffett and Munger, they all say that you should buy a business which is so good that even if in his words, I'm not quoting it, even if a stupid is running it should be good, and you should look at the business but not the manager. I think from whatever my little experience, management is very, very important. You look at, for example, we just talked about the banking. Look at the several bank licenses were given. Look at one bank versus some of the banks that had to close down or that had to merge with somebody else. One can say they are operating in the same environment, they have the same regulation, they have the same market, everything is same. Look at, for example, the cement. Classic example, it's a hardcore commodity business. How can you really differentiate from one bag of cement to another bag of cement? Market is like open to everybody, but look at the over a longer period, the growth and the ROE trajectory of one company versus the another. I think the management has made the difference. And I think when we meet, I think we try to look at their vision. I think we'll try to look at the character. We try to look at the intention, their intent, the attitude toward the minority shareholders in terms of clarity of the thought process, so many things. And these are like softer aspects, which of course, for let's say a large company which has got a long-term track record, that's in the market, you know them. But maybe for a new company, probably I think you need to assess that over a period of time.